In progress.
All right, welcome everybody. We're going to give it a few more seconds just to let some of the participants trickle in, and then we'll go ahead and jump into our materials. While we're waiting, if you'd like to, go ahead and input into the chat where you're calling in from today to see where all of our participants are located. All right, looks like we're holding strong at 25 or so here, so I'll go ahead and kick things off. All right, well, I'd like to welcome everybody participating in today's webinar, Luck of the Audit, the Role of Internal Controls in Audit Preparedness. My name is Mac Lillard. I'm a senior manager with GRF in the Risk Advisory Services Department, so I spend the majority of my day-to-day helping our clients with internal audit services, fraud and forensic accounting, cybersecurity and IT control, and just general risk management practices. So I'll be here to speak largely to the IT component of the audit and internal controls, but I'm happy to field any additional questions you all may have. But with that, I'll turn things over to Allison to introduce herself.
Great. Thanks, Max. Hi, good morning, everyone. Thank you for joining us. My name is Allison Conklin, and I'm a senior manager in the audit department at GRF. And I've spent my career working in GRF's audit department, primarily working with nonprofit organizations, so those C3, C4, C6s, as well as working with international NGOs across the world. And then I'll happy to turn it over to Tricia.
Good morning, everybody. We are so happy that you're here to join us this morning for our webinar to talk about some of these audit common findings that we come up with during our process. I'm Tricia Catabini. I'm a partner with the audit department here at GRF CPAs and Advisors. I've been in practice for about 17 and a half years at this point, primarily focusing my time on not-for-profits, specifically the association and the C3, C4 world. So that's kind of my niche. We're happy to talk through. Please, as you go through, feel free to chat us, ask us any questions. We are happy to stop and answer them as we go along.
All right, thank you both. And for participants who are seeking CPE credit today, you will be asked to complete and submit a short evaluation survey that will appear automatically following the webinar. Also, to obtain CPE, please participate in each of the polling questions that are launched throughout the session. That is how we will gauge your active participation. These will just show up as little attendance checks to verify you're listening, so we'll do our best to call those out as they pop up. But please do make sure that you submit a response to make sure that you can get credit or CPE credit for being here today. Please note that this webinar is not intended as financial or legal advice. This is simply for educational purposes. So as mentioned, we are GRF CPAs and Advisors. We're based out of Bethesda, Maryland, and we serve clients in the DC, Maryland, Virginia area, as well as nationally and internationally. Our firm serves a wide range of clients covering not-for-profit organizations, for-profit companies, schools, government contractors, associations, and others. However, our particular niche is within the not-for-profit and INGO space. We've been in operations for several decades, and in 2021, we actually celebrated our 40-year anniversary. So as you can see on this next slide, we do have a lot of areas of expertise. We started out as a traditional audit and tax firm providing bookkeeping services and outsourced advisory services. And over our 40+ year history, we have really expanded to provide any kind of level of service that a growing not-for-profit or INGO would need. So expanding into those areas like enterprise risk management, internal auditing, fraud and forensic accounting technology solutions, looking at ways to digitally and financially transform our clients, and then also looking at information technology and cybersecurity controls to make sure our clients are doing whatever they can to protect their data and the data of the participants and the individuals that they serve. So again, if you have any questions over any of these other service areas, would definitely recommend reaching out to one of your audit partners or another member of the firm with any inquiries that you have. But with that, I'll turn things over to Allison to go through our agenda items for today.
Great. So yeah, let's jump in and talk about the agenda and the talking points for the next hour of this session. So first, we'll start by talking about why an organization may undergo an audit and the different types of an audit you can get. And then we'll talk about what to expect during an audit and how we think an organization could properly plan for an audit process. And then we'll touch on some common audit findings that we as auditors have been seeing lately. And this will include a series of findings related to, a basic financial statement audit, as well as some IT, information technology findings that have come out, and Mac will touch upon those areas. And then we'll also talk about some common findings that we're seeing with the single audit. So those uniform guidance audits for organizations that receive federal funding. And then lastly, we'll talk on some best practice recommendations that we think, organizations could benefit from hearing our side as auditors. So let's start with the audit types. So there's a couple of audit types up here on this screen that we want to talk through and everything. And, there's a magnitude of different types of an audit and different reasons why organizations may get an audit. But again, the ones that are listed up here are the more common reasons that we are seeing. And so first, an organization may have either a state or federal legal requirement to get an audit, right? So states may require nonprofits to submit their audited financials when they're trying to get their charitable registration status with the government. And then there also may be filing requirements for organizations that receive a certain amount of revenue in a given year. So really, this can be dependent on any state's criteria and what may, ultimately mandate a requirement audit for financial statements. And then there could be federal requirements as well for organizations that receive federal funding from any government source. So federal, local, state, they may have different criteria based on the funding source. So, but if an organization does receive more than or expend more than $750,000 of federal funds in any given fiscal year, then they'll be required to obtain a single audit, also known as a uniform guidance. And we'll touch upon more about this in the later slides. And then we also have funding from foundations and other entities listed up here. So another reason organizations may obtain an audit is for grant funding from private foundations or other entities. And we see a lot of private foundations ask for copies of nonprofits' latest financial statements when nonprofits go to seek funding or seek a proposal. And so if an organization does receive a grant, the grantor could require, financial statements, audited financial statements as part of the terms of that grant. So there's a reason why, organizations may seek out, audits for foundations, and basically they want to have transparency, right? So many will consider funding only nonprofits that they consider financially responsible, and an audit report validates internal controls as well as the financial statements. And so establishing that degree of financial responsibility in turn could then expand the number of grants that an organization could receive. So then the next two that we have up here are governance, due diligence, and transparency for donors. So I think we can all agree that financial, statement audits can be a cumbersome process, and it requires time and resources and a lot of effort that goes into making sure that an audit process goes off smoothly. And so the results of an audit can also be proven to be valuable to an organization. So an organization wants to make itself look transparent, and by presenting their financial statements that are audited to donors or members or sponsors, that could put a little more confidence in those third parties and making sure that the organizations are properly spending the funds that they receive from them, making sure that they're in accordance with the donor's intent and everything. So there's a little bit more, confidence that can come out of an audit process for grantors or donors or sponsors. And then additionally, simply put, an audit process could provide opportunities for improvements and efficiencies in the organization. Having a third-party audit firm come in and look at your organization's financial statements and internal controls, as well as policies and procedures governing the organization, it could help identify mistakes, omissions, overspending, inefficiencies, other issues, or things that, simply might just be missed by management looking at those financial statements. So by having someone outside of your organization come in, it could provide, additional perspectives and encourage, organizational growth within the organization.
Yeah, and Allison, one thing I really want to touch on is that these are a lot of great points for why an organization obtains an audit when there's a specific requirement around them, whether it's a legal requirement, whether your board is requiring it. But we've actually seen a lot of organizations here lately where management wants to have their financial statements audited, which is great from a transparency perspective. Maybe their board doesn't require, but management wants to ensure that their fiduciary responsibility as they oversee the organization from a day-to-day perspective is really operating well. So I think that's also one area where we are starting to see a lot more I guess, fruition coming from other people within the organization, aside from what we see from a requirement perspective for an audit. So again, ensuring that if you are running an organization, if you are managing a not-for-profit, really best practice recommendation is to obtain that audit, because you may not fall into these buckets. One of those big types of organizations that may not are simply those C6 associations, right? A lot of times they're not required to get an audit. Sometimes the board doesn't necessarily look for that either. So a lot of the CEOs, COOs that I'm starting to talk with are like, it's really best practice for us to do this. We really should be doing it from a year-to-year perspective. And it's been 4, 5, 6 years sometimes when we get them into our door and engage with them since they've had that last audit. And they're starting to see really the benefit of having that on an annual basis. So from our perspective, again, we're going to talk about best practice recommendations from an audit perspective, a process perspective, but really best practice overall is to obtain an audit for your organization.
So let's talk about some different types of an audit that you can get. So first we have your basic financial statement audit, and this is an examination of an organization's financial statements to issue an opinion on whether the financial statements are presented fairly in accordance with accounting principles generally accepted in the United States. Then we also have a single audit, so uniform guidance audits for organizations that receive and spend more than $750,000 in federal funds in any given fiscal year. And this type of audit would include your basic financial statement audit, as well as a compliance examination over the federal awards. And an auditor would then render an opinion on an organization's compliance requirements with respect to the major programs. So it's kind of a two-part series there with the single audits. Then we have compliance audits that you can get. And compliance audits are mainly examining the processes and policies of a business or a specific department in an organization. So the aim really here is to check whether the business is compliant with regulatory or internal standards. And then we have employee benefit plan audits. And these audits relate to an organization's 401k plan, a pension, or profit sharing plan. And they're intended to provide assurance that the plan in place is compliance with applicable laws and regulations, DOL, and make sure ultimately that the plan will be able to fund the future benefits to the participants, that are participating in the plan. And organizations that have more than 100 eligible participants to a plan would be required to undergo this type of audit. And then lastly on the screen, we have internal audits. And I'm actually going to turn it over to Mac to talk about that in a little bit more detail.
Thanks, Allison. So yeah, just to start off, just wanted to go through kind of the basics of the difference between internal and external audit. As Allison just covered on that last slide, external auditing looks at the accuracy of a company's financial statements and whether its accounting practices comply with the applicable rules and regulations, generally accepted accounting principles in the United States, or potentially single audit or other standards. The auditor also verifies that the financial reports and records offer an accurate picture of the company's performance. Whereas internal auditing, the overall goal of internal auditing is to make a company more efficient, more profitable, and better at making key decisions. So overall, in terms of the process for an internal or external audit, generally speaking, the process is very similar in terms of you have your planning and information gathering phases. You have your field work where you perform the majority of the testing, interviews, compilation of all of your support for any of the recommendations or findings. Then you have your reporting and follow-up and your monitoring and evaluation. So in terms of the engagements themselves, not too different of a process, but the scope and objectives are where internal and external auditing really differ. So for example, as far as an internal audit goes, a company could order an internal audit of its procurement practice. The auditor would look at the system for tracking procurement activity, that being either the accounting system or an AP or requisition system, or for certain organizations, you may actually have a specific system for procurement. So the auditor would leverage that system, use that to determine if the procurement transactions were performed in accordance with defined policies and procedures. And that aspect of the internal audit would not be very different from the external audit. If, again, you do undergo a single audit or you have procurement that's tested as part of your external audit process, we would be doing similar procedures to make sure that everything's being done in accordance with policy, procedure, regulatory frameworks, and best practice. Where an internal audit would dive a little bit deeper would actually be to look at the processes themselves as opposed to simply compliance with the overall policy. So we would look at the process to determine where there are potential bottlenecks, pain points within the process or within the system, and we would try to identify ways to correct these issues, whether that be aimed at trying to streamline the process, to reduce processing time, whether that's looking to improve control mechanisms, or if it's just trying to identify where these issues are occurring so that we can provide additional clarity to staff who are involved in the process. Again, the specific scope and objectives may differ depending on the different objectives and what the client or the group is trying to get out of that assessment. So just talking about the structure of internal audit, internal auditors or the internal audit department can be employees of the company. They can also be outsourced providers, whether that's under a co-sourcing agreement where the internal auditor firm is working hand in hand with management to administer the internal audit plan, or they can be fully outsourced providers where the outsourced provider is actually developing the internal audit plan, performing all of the procedures, and reporting to the board of directors. So speaking of that, in its truest form, or in accordance with the IIA standards, the internal audit department is independent and objective, meaning that they report to the board of directors as opposed to management. While they do work with management to perform all of their internal audit procedures, ultimately their end reporting responsibility is to the board of directors.
I think one of the other key highlights too, Mac, is really the differences in the internal audit and kind of the organizations that typically get internal audits, right? So when we look at our composition of our clients, I am not asking my C3 organizations with $5 million, one location, to necessarily get an internal audit performed unless there is some kind of a risk that we deem to be a little bit higher. A lot of times we see our organizations who are international, not-for-profit global organizations. They are the ones that really have an internal audit flow and process that is on an annual basis and is consistent. The federal government, for instance, also has an internal audit process as well. Are there any other types of organizations you typically see getting internal audits performed?
No, I think you really covered the bases there. And that kind of does lead me to one of the cons of internal auditing, in that it obviously does have cost considerations. It does distract from the normal day-to-day operations of the individuals who are responsible for providing documentation or meeting with management. It does serve as a potential distraction, but again, we do feel that in most instances, the benefits far outweigh the disadvantages or the issues encountered during an internal audit. And Tricia, you made a great point about the organizations you see engaging in these types of assessments or internal audits, that they are typically larger organizations that have that budget flexibility, have that need. But you also mentioned, in the event that a particular organization or a client of yours sees a particular risk that is higher than others, that is, at the heart of internal audit, it is a risk-based approach. So it is served or aimed at the purpose of mitigating potential risks to the organization. You can mitigate risks through process improvement, streamlining of operations, additional control mechanisms, but ultimately you are trying to mitigate some sort of risk as a result of that internal audit. That is typically one of the objectives. So to your point, Tricia, as far as organizations we see that typically engage in internal audit, those would be ones that have a higher risk profile depending on the areas that they operate in, the size of their operations. Obviously, the larger an organization gets, the more complex it gets, the more stakeholders there are, the more areas where there are opportunities for bottlenecks or pain points and things like that. So you do typically see formal internal audit departments or internal audit engagements being performed at larger organizations who, again, have that budget flexibility. But just because something is, referred to as an internal audit doesn't mean that other organizations aren't doing this. It may just not be referred to as a formal internal audit because, again, in its truest form, in accordance with the standards, an internal audit is reported to the board of directors. It is independent and objective, but you can still do an internal assessment leveraging your skills, knowledge, and expertise in-house. Again, if you identify a particular risk area that you feel needs deeper analysis, it may not be a formal internal audit, but it can be a particular scoped out assessment or review, risk review, whatever you want to call it internally, that serves the same purpose as an internal audit. So again, did want to make that delineation, just kind of in between the terminology there. But yeah, I did just wanted to touch on a couple again of the pros and cons since we started talking about that. But in terms of the pros of internal audit, it really does help provide enhanced decision making. Again, it provides a deeper analysis into some of the pain points and bottlenecks within certain processes. It also is done in conjunction with the strategic plan. So ultimately, the internal audit should be planned and defined in a way that is going to ultimately support the strategic plan or the strategic objectives of the organization. So tying in the risk mitigation to how this supports the overall strategic plan and critical business processes is really important to just, again, improving the decision-making capacity at the organization. Also, just generally speaking, improves operations and efficiencies. Again, as we mentioned, most often internal audits are designed for the purpose of process improvement, finding ways to financially or digitally transform, mitigate any kind of issues within key business practices. So again, it just helps the organization to operate more efficiently, effectively at lower costs, reducing manual labor. Also helps to define and mitigate those risks. Again, part of the internal audit process is performing an actual risk assessment to understand the risk universe or the risk profile of the organization. And from that risk assessment, you then develop your internal plan and your testing procedures based on your prioritized risk ranking. So it helps you to define and mitigate the risk that could potentially pose the biggest liability or the biggest potential disruption should an unforeseen risk event occur. And then, like the team had already alluded to, it helps to ensure compliance and success in your external audits. If you're doing things throughout the year to make sure that your controls are in place and operating effectively, ultimately, when your external auditor comes in, they will hopefully find the same thing because you have been continuously auditing and monitoring it throughout the year. But with that, I will turn things, I think, back over to Allison.
Great. So yeah, let's start, before we start with the common audit findings that we're seeing, let's start talking about what to expect during an audit. Because a lot of times, we get the questions in an audit process, why we're doing something. They don't understand, management might not understand why we're doing something for the audit. So let's start with the pre-audit meeting. Typically, auditors will start with having a pre-audit meeting prior to fieldwork commencing. And this could be held with management or governance, but basically the idea is to talk about the organization's activities for the year under audit. And we want to know any significant changes that happened during the fiscal year from either the prior year or historically. We want to know about any staffing changes, any program, any new programs, any programs that ended. We're concerned with any issues or, other matters that might have affected the organization under the period of audit, as well as subsequently through the date that our audit is performed. Because ultimately, all of this affects our risk analysis. When we're going in and trying to properly plan for an audit, we need to know this information so that we can, ensure that we're covering either the riskier areas or, areas that might just be new to your organization. We want to make sure that we're getting our comfort matter, in order to issue an opinion on your financial statements. So that's probably the first area that auditors would focus. Then we would start talking and making inquiries with management and other firm personnel. And this is really where a lot of our, organizations that we audit come in and, kind of ask us why we're, basically talking to other personnel in the organization. And this matters because, we're going to do our due diligence and ask, inquiries of your finance department, making sure accountants and, everyone that is handling the financial statements and giving us their data, we're making sure that we're asking them about, any fraud, any issues or anything like that. But then we're also on the back end, we want to talk to different departments in your organization, right? So we want to talk to, if you're a membership organization, we'd like to talk to your membership director. If they're your compliance, we want to talk to program people, grant people, different personnel people, because we want to get a feel of how, different departments are connecting in your organization. Because ultimately, those people might not be producing the reports that we're looking at for the audit, but they do, play a critical role in deriving those numbers that go to the finance department. So membership coordinator, we want to know the internal controls about that, about that department in your organization. We want to speak to that person. We want to speak to the program people, and we want to get a feel for how things are operating. And then we have test of account balances and review of internal controls. So we'll most likely ask for, many different things in the audit process. We'll want to see policy documents, financial statements, accounting records, and other things, things that play a critical role in us examining your financial records, ultimately, again, to render that opinion on your financial statements. And then we'll also look into your internal controls. We'll want to see, the processes in place, the reviews and approvals. We'll want to make sure things are being properly done and documented so that we can verify that those, controls are operating. And then ultimately at the end, we'll have the deliverables. So once we've obtained, reasonable assurance that your financial statements are presented fairly, and no material misstatement exists, then we'll render our opinion and deliver the reports to governance. And also I want to highlight, management's responsibility for the financial statements, because sometimes, this gets a little mixed in with, auditors and whatnot. And I want to point out that management is really responsible for the internal controls of the organization. So they're responsible for designing, for implementing, and, ultimately making sure those internal controls are in place. We as auditors obviously cannot do that. We cannot, make a policy or define your organization's policies. So when we're coming in for the audit, we have to know that background information of your organization and make sure, that ultimately we're seeing that throughout our audit process.
Allison, before you move on to the next slide, one of the other things I just wanted to kind of touch on when you talked about the test of account balances is to, just as a reminder, we do not test 100% of everything. We do sample. And that sample is based on, as Allison already mentioned, our risk assessment process and procedures. One of the most common, I think, complaints, I guess I would call it a complaint, that I hear is when I have a new client transition to GRF, and there's always a commentary, well, I didn't ever get so much requests from our prior auditor. Bear in mind that prior auditors, if you do transition to a new auditor, successor auditor, they don't necessarily understand your organization. They don't understand your internal control process or procedure. They don't understand how things are recorded within your financial statements until they dive in. So really that first year is likely going to feel like a heavy lift as you transition, as we get to know you, as we understand where the risks are and where they may lie within your financial statements, and as we kind of hone in a little bit more year over year. So hopefully the lift is heavy in year one, and then as we get into it, it becomes a little bit less. Of course, if we do continue to see those risks at a heightened level, we will continue to ask for that additional support. So I just wanted to kind of highlight and touch on that as well.
All right, so we have our first polling question. So if you could please take a minute to just answer this question. All right, so we can move on with some common audit findings. So let's start with some common audit findings that we're seeing surrounding a basic financial statement audit. And so the first one we have up here is lack of formal accounting policies and procedures. So a lot of times organizations, they might not have a formal, set of policies and procedures defining their accounting principles that they're using, making sure that transactions are applied consistently. And so when we're going into an audit process, we need to make sure that we are looking at your formal accounting policies and procedures manual. And it has to have, the policies, in place, and everything that's governing how you are recording transactions. And ultimately, you want to have the financial reports that are governed in that manual, ultimately to give to management and governance. So a well-written accounting manual aids in, training new employees, as well as in assisting on the segregation of duties. So a completed manual needs to be reviewed, and formally approved by governance. And a lot of times what we're seeing in audits is that, if an organization has a formal policy, an accounting manual in place, it could be outdated, right? So, it could be from 2018, and a lot of things have changed, within the last several years, right? We had the pandemic, and so that, kind of shifted a lot of organizations into, the remote world. And so maybe policies, kind of tended to shift off, and, different things were being done. And now that we're, coming out of the pandemic, and, we're out of that era now, things might not be updated in a client's manual. And so we want to make sure that anything that we're seeing in those, policies and procedures, we're attesting to during the audit process, right? So we need to know how your organization is recording transactions, the policies governing, your investment portfolio, your allocations inside there, and what you're aiming for, because ultimately this is going to affect the entire audit process. What we're, trying to search in the audit process, we're using your manual to do so.
I think one of the other things too to highlight here along with it is, while formal accounting policies and procedures are a very important item for us as auditors, internally, standard operating procedures are also very important for an organization. And those are a lot more detailed on how things are done within an organization. And those are outlined. And while we may not give that as a recommendation or an audit finding necessarily, one of the things to just hone in and think about is there's a lot of time and money spent if there is turnover in a position and having to train new staff. Additionally, there's a lot of institutional knowledge with one person in a set position who continuously does the same thing month in and month out for your close process. And so if something does ever happen and they happen to not be available for an extended period of time, having those standard operating procedures, or SOPs as we commonly see them called, will really help an organization to ensure that they stay on track. And as Allison mentioned, internal controls are a very important part of management's responsibility in a financial statement audit that will also allow you to ensure that those internal controls are maintained on a consistent level.
Yep. And that actually, drives right into the next, common audit finding that we're seeing, which is lack of segregation of duties within an organization, right? So again, this happens when, you don't have the adequate level of staffing in a finance department that, an organization may need, or you really have one person that's doing everything, right? So you could have a director of finance and, they're actively doing all the reconciliations and they're doing the financial reporting, they might be doing bank reconciliations. They might be approving and processing, payments, or completing, payroll runs and things like that. And so there's no one in the, organization to actively oversee what that person is doing. So there becomes an issue when someone has too much control in an organization. So what we really recommend is that, you have someone, and it could be someone under the director of finance, the accountant, whereas the accountant is now moving into, doing those reconciliations, really, ramping up and, putting things into the accounting system. But then you also have that oversight by that director of finance. So, what we need to avoid is putting too much control and trust in one person's hands, because there really does need to be defined segregation of duties, and also evidence of this process for the audit. For us as auditors coming in, we want to make sure that, someone that is signing off on a reconciliation is not the person also approving the reconciliation. We need to see, verification that the process is in place and that you also have controls to oversee that process by someone else. And also, with organizations, there could be, where there just simply isn't capacity to have someone, oversee some of the financial reporting. So if that director of finance is really the only person that you have in the finance department, then maybe you run to the executive director or the president of the organization, where they're overseeing, the financials on a, frequent basis. It could be a monthly basis, but they are overseeing, actively overseeing the reconciliations and the reports that are being produced. And then we also have audit readiness and adjustments required. So this is the next one. And, as auditors, we, tend to see a little bit more of this than ideally we would like to with the audit process. But this comes about when organizations, I think, are just not maintaining adequate controls over their financial reporting and making sure that their reconciliations are done frequently, if not monthly. So if an organization, you want to make sure that your account balances in your system, in your accounting system, are reflective of, the true value of those accounts. And if there's any discrepancies in the accounting system, or, with your schedules that you're, taken care of outside the accounting system, that any of those discrepancies are investigated timely, right? Because, a lot of times we see organizations where we will schedule the audit and, 2 weeks before leading up to the audit, they are still reconciling their year-end numbers. And ideally, this is not what should happen, right? Because, in 2 weeks, you can't really cram in a whole fiscal year and trying to reconcile everything. So we really want to make sure that organizations are doing this reconciliation process, frequently. They're making sure that the financial statements that they're producing from their accounting system are adequate and, reflective of what, they're seeing in their, schedules and everything.
And so
And
I think
also, go ahead.
going along with the audit readiness too, Allison, right? If you're trying to cram everything into that year-end process, you're keeping your books on a cash basis. Your board also can't make appropriate decisions from a due diligence perspective on what they're going to do from a strategy standpoint. So it's also very important for those internal financial statements on a monthly or quarterly basis, depending on how often you report it to your board, are really shown on that accrual basis as you would have reported in your financials.
Yeah, exactly. And if you're coming up to field work, the audit field work, and your balances are not reconciled, you're only leading, into trouble, because the audit, will most likely not go smoothly. You'll run into delays, the audit costs will go up, and most likely you'll have audit adjustments posted throughout the audit process, whether those be, provided the adjustments provided by management or proposed by auditors. You'll have adjustments to that preliminary trial balance that was given to auditors. So in turn, we would have to report that to governance, the audit adjustments, and most likely, if they are material, then it would be written up as a finding. So we want to make sure that the numbers that you're giving to auditors are, completely and accurately stated.
And that kind of leads into revenue recognition inconsistencies. I think a lot of the times what we see with revenue recognition is that, especially in light of contribution revenue and how that is recorded, sometimes if you get a change in personnel, or sometimes if you happen to have a revenue item that maybe you don't see all the time, perhaps, but you may see a couple of times during the year, really ensuring that there's consistency with how things are being recorded. One great example I would like to give, while we have this new clarifying standard that came out a couple of years ago related to contributions and how they are recorded within your financial statements, there's still a lot of gray area when it comes to those grant agreements. A lot of times they are still written in such a way that there's a lot of judgment that's required in understanding, does this get recorded now, or is there a barrier that perhaps this contribution is now considered conditional? So really having that policy outlined in place to understand what types of things you look for in those types of agreements that would consider it to be conditional. Obviously running that by your auditors, because there is still the US generally accepted accounting principles that has to be applied to that, and making sure that it's in line with it. But there, again, is still some subjectivity. So making sure that you are recording those on a consistent basis. One of the many things that we typically see is there may be some conditions that maybe could be a gray area in terms of, is it related to the purpose? Yes. But is it considered an administrative task or burden that isn't related to the purpose? That's really one of those two places where there could be some overlap and there is that subjectivity. So again, making sure that you are looking at one grant agreement, how you recorded it, if there is any question in the past, versus what kind of an agreement you're looking at now today, and how that ultimately will also get recorded. So making sure, again, that you're consistent from year over year. The other area is, again, we've got a lot of changes when it comes to membership dues, processing, invoices, et cetera, when it comes to those C6 or C3s that are operating much like C6 organizations with membership dues. So again, making sure that there's consistency in how things are recorded. Changes in outsourced accountants, changes again in your internal personnel can create a lot of inconsistencies. And because of where we stand today, and in light of the shortage of finance people, of accountants in our pipeline and in the industry as a whole, we're also seeing a lot of turnover, unfortunately, in the finance departments at our organization. This is one of the big areas that we're really starting to hone in on with revenue recognition, just because of that turnover that's starting to occur. On top of it, we're seeing a lot of new accounting standards that are coming out. The most recent one here is related to those financial instruments and expected credit losses. We've had a lot of organizations who have been December 31, 2023 year ends that have done an evaluation much like they've done in the past, just based on historical analysis. But really, that new standard requires you to not only look back, but also look forward, and also look at your individual customers or clients that you have. And so with that, while you may come to a conclusion that it is overall immaterial from an audit perspective, you are still required to look at that standard and you are still required to adopt it. So if you are not performing the evaluation as it should be done under that new standard, it's going to become a written finding that we have, or at least a recommendation at that level. Because again, you should have those policies in place and you should be performing the evaluations based on those new standards as well. The lease standard has also been one that was kind of a sticking point over the past year as well, looking at what people may have considered to be short-term leases, looking at what people would have considered to be necessarily immaterial to their financial statements. And again, while that may be a management decision, the auditors also really need to be involved in that process from a discussion standpoint, because what you may consider to be immaterial may be considered material from our perspective. So again, making sure that new standards, this type of education stuff that we give out to you all from a webinar perspective, really make sure that you're up to date with what's coming down the pipeline. As of right now, we're pleased to report there aren't too many new accounting standards updates, but there are some talks at the Financial Accounting Standards Board level currently that may impact some of our nonprofits. So we remain ready on that and we'll report out as needed. So again, making sure that you have the proper education in place as well is one big recommendation from our standpoint from what this finding may cause from a recommendation.
All right, and now I just wanted to go through some of the audit findings or common audit findings that we're seeing from an IT or cybersecurity control perspective. And the comment that we are seeing most commonly is this top one here regarding information security policies and procedures. And I think it's easier for me to honestly just say everything that Tricia and Allison just said in regards to the accounting manual and the segregation of duties, I think can be applicable to the IT policy or the information security policy. Documenting all of your controls from an IT perspective in some sort of narrative format provides all sorts of value, from continuity to accurately capturing your control design, to providing guidance to internal staff and any kind of donors who may actually be requesting proof of information security policy. So I wanted to just go through these items that you've seen bullet listed here. These are sort of what we deem to be the most critical controls that any organization, regardless of size, complexity, and infrastructure, should have documented. And since this is kind of a newer area to some organizations, at least as it ties into the financial statement audit process, I just kind of wanted to relate this to the standard financial statement processes, just to, again, make it a little bit more applicable and hopefully digestible. So for example, when we're looking at this policy listing on the left, this would be the IT equivalent of your accounting manual that captures all of your IT controls, similar to how you have your accounting manual set up with different control modules like cash disbursements, payroll, cash receipts, revenue recognition. You would have these different control modules under there. So access controls is really the area that we emphasize most to our clients. So your access controls or your access control policy will define the process for granting and terminating user access rights, as well as the process for maintaining and protecting access to those credentials. So understanding who the initial point of contact to grant, terminate access to your email accounts is. A lot of organizations leverage Microsoft 365. So who would be the first point of contact to involve in terms of granting or terminating user access rights? Typically that goes through human resources, who would then either contact the internal IT personnel or your managed service provider or IT consultant to set them up with access to email and basic system access. The policy should then go on to identify the critical systems that are in use at the organization, the data they hold, and the individuals who are responsible for maintaining the user permissions within those systems. For some organizations, this may all live within IT. IT may be kind of the first point of failure for all things access rights. But for a lot of our clients, this will sort of be delineated in that the individual within the organization who is sort of the platform or vendor relationship owner will be the one who owns the user permissions for that. So, for example, in a lot of cases, we see IT or the managed service provider will be the first point of contact to set up basic system access. And then for the accounting system, bill payment platforms, CRM, that would actually rest with finance. So finance would be responsible for assigning the specific user permissions within the system and then making sure that those are updated and maintained in accordance with policy. Similarly, you may have marketing overseeing your marketing platform, sending out your newsletters. Human resources would be the owner for the human resource information system, so on and so forth. Then jumping into backups, this is an area that creates a lot of confusion right now because, again, many of our clients leverage managed service providers who handle all things or IT, or they're also leveraging entirely cloud-based software as a service for document storage. So essentially, you're reliant on a third party for all of your backup storage and retention. Even if this is applicable to your organization, you should still have a backup storage retention policy. This would be a little bit more simplified because this would be really a matter of cataloging your third-party systems, the documentation they store, as well as the associated level of risk. So, for example, your human resources information system would have all of your personally identifiable information. That would be a high-risk system, similar to your accounting system that holds your financial information, whereas maybe an on-premise server or a Dropbox or a SharePoint may not be as high risk because the information it holds are all administrative documents that if they were to become compromised, wouldn't pose significant risk. So again, documenting all of your critical systems, the information, documentation, data that they store, and identifying whether or not you're relying on a third party for that document storage. Again, if it's a cloud-based system, or if there is somebody internally who's responsible for backing up any kind of physical server files or anything like that. Your incident response plan, and this also kind of builds on disaster or is coupled with disaster recovery, which I'll cover on the next slide, but your incident response plan will kind of pull together the 4 steps of incident response, which as NIST defines it as the preparation, detection and analysis, containment, eradication, and recovery, and then the post-incident activity. So again, this would define the process for following up on any sort of issue related to the IT environment, any sort of breach, system outage, or anything like that. So again, you would want to identify the appropriate personnel who are going to be responsible for acting, reacting, and managing relationships with vendors that may be potentially impacted by any of these incidents. Cybersecurity training is just going to outline the mandatory requirements for all employees from a cyber training perspective. So in most instances, that's going to be some sort of onboarding training for new employees, and then a periodic refresher, whether that's an annual cyber training, if you're pushing out monthly or quarterly trainings, or if you're even doing maybe monthly micro trainings to just limit the time required for employees to complete that. Whatever your protocol is, just making sure that it's captured in that policy. And then lastly, cyber risk management, what the overall process is for identifying, assessing, monitoring, and evaluating risks on an ongoing basis. And this may actually just be a part of your larger enterprise risk management program that's already in place and just be sort of the cyber or IT subcomponent of that process. Third-party risk management, I don't want to spend too much time over because I actually have included a link here as well as the link above to provide some more information and some more context to these recommendations just over developing third-party risk management policies. But this policy would just cover how you monitor and evaluate your third-party vendors. So most organizations have a procurement and vetting process that they do before contracting. This would go beyond that and identify all of your procedures for performing ongoing monitoring after the initial contracting. So this policy would define the individuals who are responsible for assessing third parties and their related risk ranking. This could be done during the procurement process. This could be an add-on step to state whether this particular vendor is a high, medium, or low risk based on the services they provide or the data that they have access to. The policy would also define how they're risked, how they're risk ranked, and then based on that risk ranking, high, medium, low, critical, whatever your organization uses, what those monitoring procedures that would be applied to those vendors. So in most instances, your high or critical risk vendors might be your top 10% of vendors. And those would be the ones where you really have detailed monitoring procedures. So some of the best practices we see is that for any organization that works with a service organization for retirement plan contributions or for particular IT services, obtaining and reviewing an SOC1 or SOC2 report on an annual basis is best practice to make sure that there's no significant deficiencies or findings that would give you cause for concern as one of their partners that may potentially impact or compromise your data. But again, would definitely encourage everybody to take a look at that third-party risk management link, as well as the Getting Started with IT and Risk Management Policies and Procedures manual. On the next slide, this access controls and monitoring of administrator accounts really builds on the access control comment before, but I wanted to hone in on this specifically because this is actually kind of going beyond that to, as we like to say, watch the watcher. So ultimately, one individual or a group of individuals within the organization will have to have those administrator or those super admin responsibilities in order to grant terminate user permissions and everything. So it's important to watch what those individuals are doing, because those individuals have essentially the keys to the kingdom, where they can add, remove vendors from systems, add or remove employees, change payment information, ACH information, make changes in the system, remove certain activities. So it's important to review their audit logs over whatever systems it is that they have access to make sure that they're not making any kind of unauthorized changes. So this could be delegated to somebody in IT. This could be the actual vendor or platform owner themselves. Again, depending on your organization and context, it might be different. But again, it's important to have those policies in place to watch the watcher or review those super user admins on all of your critical platforms. Business continuity, disaster recovery builds on incident response, but goes through the process of cataloging all of your key systems and critical business processes, identifying the key point of contact or personnel responsible for administering or overseeing them, assigning a backup in the event that that individual is unable to meet their day-to-day responsibility, and creating a detailed plan to respond to your top risk events. So if ransomware or a cyber breach is one of your top risk events, what plans or what procedures do you have in place to respond to those? Have those been tested? Have they been verified? Does everyone know what their role is? And lastly, a system data flow diagram really just helps to illustrate the flow of information between your different systems. So we typically do like to see this for the financial environment with the accounting system at the center, and then all of your supporting applications, whether that be CRM, bill payment, human resources information systems, all of the information that is flowing into and out of that system is just really helpful to, again, kind of illustrate this to auditors, to stakeholders, how one system could potentially impact the activities of another system so that they understand, again, the risks and their role associated with properly maintaining those.
All right, so let's go through some common audit findings with a uniform guidance audit. Again, the single audit, some organizations expend more than $750,000 would be required to obtain a single audit. So some of the common findings that we're seeing right here are time tracking and payroll allocations, as well as procurement requirements, suspension and debarment, subrecipient management and monitoring, cash management and draw process, and then audit account reconciliations and timeliness of an annual audit. And let's take a moment to just answer polling question number 2. While you're doing that, I will continue. And so let's first start by talking about time tracking and payroll allocations. Federal regulations require that charges to federal awards for salaries and wages must be based on records that accurately reflect the work performed, and that those records must be supported by a system of internal control, which provides reasonable assurance that the charges are accurate, allowable, and properly allocated. So these records must comply with established accounting policies and procedures of the organization. So a lot of times organizations that first receive federal funding or do not have a sophisticated way of tracking employee time, we will see organizations that do not have a reasonable basis for allocating time to different projects. And I say sophisticated, and what I mean by that is that nonprofits may not have their accounting system set up in a way to properly allocate employees' time that coincides with the level of effort that an employee is putting into a particular program or project. And so grantors have a specific requirement, that the time charged to their award must be based on the level of effort that an employee is ultimately doing on that project or that grant. So a recommendation here would be that employees complete timesheets that pertain to each pay period, and the timesheet documents the allocation of the time worked to the different programs and projects. A lot of times, we might see that the allocations that, come from a timesheet do not match what's recorded in the general ledger. So we want to make sure that management as an internal control is doing that process and making sure that the reconciliation between a program allocation and ultimately what's being produced from the general ledger matches. And if there's any discrepancies, then management goes back in and fills out why a discrepancy came about. And then let's talk about procurement requirements, because this is another one that we often see with our clients. Federal regulations require recipients of U.S. federal funds to use their own documented procurement policies, which reflect the applicable uniform guidance requirements to procure goods and services in order to ensure that all purchases are conducted in a manner that provides for full and open competition. So first, we want to start with making sure that organizations first have a formal policy in place that aligns with uniform guidance requirements. So uniform guidance requirements dictates that anything, above under $10,000 US, that's a micro purchase threshold that they're using. So anything under that, procurement, competitive bids, not necessarily required for those purchases. So anything above 10,000 and up to 250,000 would require, competitive procurement, making sure that organizations are documenting their procurement process and making sure that bids are received and ultimately an awarded vendor or supplier is documented. So first, we want to make sure that the client, organization has that policy in place. And it's typically fine for organizations to have a lower threshold than the uniform guidance requirements. So an organization might deem their micro purchase threshold at $5,000. That is totally acceptable. It might align more with the organization, and their budgeted numbers and their expenditures and everything like that. It's just when we go in as auditors, to attest to their policy, we want to make sure that anything really above $5,000 does have procurement. Management can't come back and say, a 7,500, vendor, didn't have procurement because it's under the uniform guidance requirements. Well, we, as auditors are again attesting to your internal policy. And a lot of clients, that have the policies in place that, follow the uniform guidance, we want to make sure that those policies, are defined and everything. And, ultimately the procurement process needs to be documented when we're coming in, right? We want to make sure that, everything is documented in a way that we can verify that procurement was done. And on the next slide, I want to talk about non-competitive procurement, because this is, again, really where we're seeing a lot of the federal findings that come about, because, you have your procurement process and, organizations are following that, but then you have your non-competitive procurement. And, there are situations where you can apply non-competitive procurement, and we have them listed here, where the micro purchase threshold might not have been met. So it's under 10,000. So you don't have, competitive procurement. The item or service is only available from a single supplier. So you would have a sole source justification, or, you're running into an emergency situation and you're not able to fulfill that full procurement. Or, you have a waiver from a federal agency saying, you don't need to go through a competitive bid process. Or after a solicitation of a number of sources, you deem that competition is deemed inadequate. So ultimately, you have circumstances where you can apply non-competitive bidding. But the issue comes in when we're often, seeing sole source justifications. Organizations might be telling us that there's only really one supplier or vendor that provides this, service to the organization, or we've been using the same supplier for a number of years and they've been fine and there's no issues. But really that is not, acceptable under federal regulations for procurement. You do have to continuously go out to bid and seek, proposals or bids from other suppliers. You might have, entered into a contractual agreement with a vendor in, 2018, 2019, but, they might have been the best price point at that point. But, years later, you do really need to go out and seek new contractors or vendors and see if, maybe they have a better price in point at that time. So a lot of, issues come about when, clients start to give us these sole source justifications, and really, there's not, background, or there's not enough evidence to support the sole source justification. So we want to make sure that, organizations understand that non-competitive bidding is allowed in certain situations, but, the criteria all listed here is in place before they can really provide that sole source justification to us. And then let's talk about suspension and debarment, because this is another common, audit finding that we are seeing. So federal regulations restrict awards, subawards, and contracts and suppliers, from ultimately for certain parties that are either debarred or suspended or otherwise excluded from, federal assistance programs or activities. So organizations have to ensure that any federal money that they're giving to contractors, suppliers, vendors are not excluded or disqualified. And in order to do that, organizations have to perform these screenings using either a platform on sam.gov, the Systems for Award Management, or by performing an OFAC check. And OFAC stands for Office of Foreign Assets Control. And both of these websites have a spot in there where you can go in and simply, put in your vendor or supplier name, and it will screen that supplier or vendor within seconds and ultimately show you if they are suspended or debarred from dealing with the United States government. So a lot of times when we're going into our audit, we do not see these screenings either being performed, they might have been performed by management, but not documented. So ultimately we cannot verify that they were done, and we need to see that they were done prior to payment or prior to entering into contractual agreements with parties, right? Because we want to make sure that any money that we're giving to these third parties, that they're not on the list that's suspended or debarred. So ultimately the screenings need to be done prior to the payment contractual agreement. And also, I want to make sure that organizations continue to do the screenings, yearly, because, if you have a vendor that you've selected in a few years prior, they might not have been suspended or debarred in that year that you did the screening, but situations can change over the years. So you want to make sure, at least on an annual basis, that you are performing these screenings. And then subrecipient management and monitoring. This is another one where we're seeing, a lot of findings come about from the single audit report. And this has to do with, organizations that are passing federal money through to subrecipients to help with their, programs and making sure that they're implementing them, but then your organization is passing money through. So federal regulations require that you risk analyze and make sure that you're documenting, how you're assessing each subrecipient. Again, I think Mac alluded to this earlier, making sure that you're either assessing a subrecipient as either high, medium, or low risk. And ultimately, if you are doing high risk and you're assessing them at high, what monitoring procedures are you going to have in place for that subrecipient? If you're saying low, okay, well, are you making sure that, you're seeing that subrecipients audit report on an annual basis, checking out, if they have any findings, making sure ultimately that you're not passing through any federal money and you're not putting it in the wrong hands of a subrecipient. That's ultimately the goal here. And you want to make sure that you're documenting all of these subrecipient policies that you're doing and monitoring. You're following up with the subrecipient. You're making sure that they're submitting financial reports timely and, spending the money that they're passing through properly. And then we have cash management and draw process. So when entities are on a reimbursement basis, program costs must be based on, program costs that were incurred prior to requesting reimbursement from the federal government. So when funds are advanced, recipients, also must make sure that they're minimizing the time elapsing between the transfer of funds from the government and when they're spending those funds. But a lot of times, organizations might be on that reimbursement basis, and we want to make sure that, organizations are requesting drawdowns and funds from the government based on, expenditures that have already been incurred. A lot of times what we're having findings surrounding are that the draws are based on projected expenditures or budgeted expenditures for the future. And typically that is not allowed with the federal government. You must be based on what you've already incurred. You can't request reimbursement if you have not incurred those expenses already. So we want to make sure that first the drawdowns are being reimbursed from eligible expenditures that have already been incurred by the organization, and that there's, kind of a review and approval over the amounts that are being requested by the government. We want to make sure that someone else is seeing, the financial records and making sure what that reimbursement looks like. And then ultimately internal controls, for clients, for organizations, in order to keep track of everything, they want to have, a separate schedule that might show them the reconciled amounts and the drawdowns, and ultimately, capturing where the drawdowns are being placed and where they're, kind of matching up with the expenditures that were incurred for each organization. And then lastly, we have account reconciliations and timeliness of annual audit. I think, we spoke on this a little bit earlier with basic financial statements audit, but this also comes out with single audits. And really what we're making sure is that, the accounts are reconciled and everything is submitted properly and timely for the audit process. And that, if there are, major adjustments to, financial statements, that those are needed, those will be required to be reported as a federal finding to the US government. So we want to make sure that ultimately, when you're producing the reports, again, we're relying on those numbers to be accurate when we're coming in for the audit process, that those really are accurate and that you have substantial backup, substantial, subsidiary schedules that really support those numbers that are being produced. And then we have just a few best practice recommendations just for, what we're seeing, what we've typically been seeing lately with organizations, things that, might not be so much more common, but things that we wanted to quickly highlight for you all. And so for the first one, procurement policy for non-federally funded organizations. So any organization could adopt a procurement policy. And we think, it's just in the best interest of any organization to have a procurement policy, because really we want to make sure that organizations are, soliciting, the best vendors and suppliers for their organization and making sure that they are getting the best price. So we think, any organizations could, adopt a procurement policy and follow that. And then background checks and credit checks for persons dealing with financial information. So not just your background checks, to satisfy the uniform guidance audit requirements, but background checks for, any person in your financial department, your financial and accounting department, as well as credit checks, right? Because these are the people that are really dealing with sensitive information in your financial records. And we want to make sure that those people, have, obviously the right controls, and we want to make sure those people can be relied upon to see all the data and, the information of an organization, and making sure that, no one is really, outside, with, credit checks that are not, what we would want to see with people handling those job functions in an organization. And then also ensure you're performing the background checks on international staff. So for expatriates and, those types of people that, are working abroad, we want to make sure that those people are not suspended or debarred from dealing with the United States government. And then review and approval of executive director, president's expenses. This includes reimbursements for, travel, as well as credit card charges if they hold a corporate credit card. We want to make sure that someone else, in a higher capacity of the executive director is reviewing those charges, just to make sure that they're reasonable. We would hate to see, someone under the president or executive director, an accountant kind of reviewing, because chances are, if they were to spot check and see something unusual, they might not be comfortable going to the president or executive director and questioning it. So we always recommend, someone maybe on the board, maybe governance, maybe the treasurer, kind of review and approve. Doesn't have to be, so frequent, but maybe on a quarterly basis, they're just spot checking the statement, the reimbursement requests, and seeing that everything looks adequate and, for the organization's charges. And then lastly, work with an outside accountant, CPA. Again, I think Tricia alluded to this earlier. If a new accounting standards are being, implemented or required to be implemented by your organization, maybe just contacting, an outside accountant or a CPA, just to verify that you have all the knowledge and, the background information to make sure that you're adequately implementing that new standard. Because, prior to coming into the audit process, we'd want to make sure that, your financials are in accordance with those new standards. And lastly, polling question number 3 as we're wrapping up our webinar.
And Allison, we already did do that one, so we should be able to wrap up from here.
All right, well that concludes our webinar. Thank you so much for, participating and jumping on with us.
Thank you, everyone. I hope you have a wonderful rest of the day. Again, if you have any questions at all, feel free to reach out to any of us. We're happy and available to talk. You'll get a copy of the presentation in your email later this afternoon. And as always, you can also visit our website at grfcpa.com for resources.